Hello there, this is James and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Thursday. In today's program, I want to discuss the latest job data coming out of the United States, plus two incredibly famous traders and their opinions on the market. But before we get into that, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, another day, another bit of US job data. And today, again, we have implications that the US labor market is extremely strong. In fact, we had US initial claims came in today, and it came in as announced at 250,000 versus the expectation of 256,000. Now, don't forget, those who are new to trading, the US initial claims is when an individual signs on for unemployment benefit for the first time. Okay, so not only did it come in lower than anticipated, but they revised the previous number lower. The number last week, they revised down to 252,000 from 262,000 initially. So that means this week's number is down by 2,000. So 2,000 less people are claiming for unemployment benefit for the first time. The other thing, which is encouraging as well, US continuing jobless claims. This is the number of people who are still claiming for unemployment benefit. This was announced lower than anticipated at 1.437 million versus the expectation of 1.438 million. Okay, so again, that was better. So what this is sort of indicating, is not only do we have still a very robust US labor market, but it is showing that if someone does lose their job, okay, are made unemployed, it doesn't take them long to find a new job. So they're finding work pretty quick. Okay, so they're not stuck in the unemployment zone. You know, they're getting jobs quite quick. So this is, again, another positive sign that you have a very strong US labor market, which the Fed keeps going on about. And those who deny recession are going on about the labor market. And with job data like this, it's difficult to fight that case at the moment. But what I will say, now I want to talk about this point in a minute. In more detail. But the job market is a lagging indicator of recession. And that, what do I mean by that? But basically, that's not the first thing to go when you hit recession. That happens during a recession. Okay, so it's not, you know, it happens later. As the recession grips the market, the job market starts to falter. So that's the other thing. Another data, which again is not so good, it only seems to be labor job data, which is good. But US existing home sales was announced, announced lower than anticipated. It was actually announced at 4.81 million versus the expectation of 4.89 million. So just so you know what existing home sales is, this is homes which are been in the market for a while, then being sold or being bought, i.e. people moving house and selling their current property to buy another one. Okay, so existing home sales dropped to 4.81 million. So there is indications again that though the labor market is performing pretty strong and pretty stable. Other things in the economy is not, and the housing market is key to the U.S. economy. So the fact that it's lagging is another factor, and this is actually declining. Sorry, is a big factor to take into account. Okay, and obviously this is for the same obvious reasons. Obviously inflation, but other than that, it's the high interest rates which we have now for mortgages. So this is having an impact on the housing market. Other negative news across the ocean, across the Atlantic. Okay, EU GDP was announced as expected at 8.9%. Sorry, CPI. Sorry, not GDP. CPI. Whoops, a typo. My fault. CPI, yeah, inflation was released 8.9% as expected, but that is still a record high. A record high. So it goes on to say this inflation crisis gripping the world is still ongoing. Okay, yes, the US showed a bit of signs that their headline rate or their year-on-year inflation declined a little bit. Last week, wasn't it? But don't forget, like I said in a previous video, okay, the core did not decline. The core stayed the same as it was. So don't forget, the core doesn't take into oil or energy. Whereas the headline, the year-on-year does. So we've had a fall in oil prices. So that probably explains why we have 8.5. In Europe, of course, in the UK, we still have an energy crisis. So it doesn't matter if WTI is falling at the moment to us as much as it does to the States. So that's something else to consider. So like I say, moving on to one of my points I want to make. Obviously, we got a strong labor market, okay? And obviously, that we have a strong labor market. We had a very, very poor retail sales yesterday. We also have signs, and I've gone on about this, I've talked about this a lot, about the US property market beginning to slow down. So, we have still got plenty of bears out there who think the market is gonna go lower. They believe in it. Obviously, we're experiencing a bit of a rally since hitting the lows of June. But there's still several bears out there. And I want to talk about two in particular because these two are very famous traders. Okay, and like I say, one in particular I would listen to because he's actually a bit of a hero of mine. The other one is a bit of a personality. Anyway, let's talk about them. So first trader up is Jim Cramer. He's very over the top. Very over the top and enthusiastic about the markets. I wonder if that reminds you of anyone. But anyway, he is a very famous trader, and he has said recently, since sometime last night, actually said he believes investors should trim some of their positions as he believes the market will start to stall. And he goes on to say, I quote, "Things can still go right. I don't want to freak you out. I just think stocks need a cooling off period after this miraculous run." And he's right. We've had a miraculous run from the lows of June. Miraculous run, and we are getting one for certain. So he's expecting a turnaround. And he then goes on to say, and you should take something off the table. Other words, start limiting your exposure on stocks because he's expecting a bit of a turnaround at some point. Now, another very famous trader, like I said, this guy is a bit of a hero of mine. And I'll tell you why. Because I admire this individual greatly. Now, Michael Burries, he's a very famous trader. Just so you know, the reason what made him famous, he was one of the first investors to notice that the mortgage market in the US mortgage market back in 2007, 2008 was about to crash. Because at that point, the mortgage market was booming. Only a few people noticed it was about to turn around. And he noticed it. And he went against it. He shorted it. Okay, he's in the movie. His character is played by Christian Bale in the movie Big Short. In The Big Short, I preferred the book. The book was brilliant. In The Big Short, so he was played by Christian Bale, but a very smart man, and his hedge fund made an absolute killing. So he's a very, very smart bloke, and I admire him greatly because though I wasn't in trading around that same time as he was. I was actually in mortgages. I noticed the same thing as well. I could see the mortgage market was getting overinflated as well. So anyway, I greatly admire this chap. Anyway, he's actually announced that he's closed almost all his positions in his fund. in his fund. I'll go on the positions. Some of the positions, for example, are companies such as Alphabet, we should Google, Meta and Facebook, and he's covered his Apple put options. For those of you who don't know what put options are, those are the options you buy. Put option. Start again. You buy put options against a company or a stock if you think that company's stock value is going to go down. If you're right, then that put option could potentially make you profit. So he's actually covered more put options against Apple. So he's seeing something. He is seeing something. And he actually said, and I quote, this is what he tweeted. Is that what he said? Tweeted? Anyway, he said out a tweet, and he said, these earning reports, and by Jove, the whole season has a last hurrah feel to it. So basically saying, we have had a pretty positive earnings season in many ways. Certain companies surprised us. But he's saying that it sort of feels that it's their last sort of cry of victory before we start seeing a reverse. So anyway, it's interesting that these two famous traders, despite the job data, despite the semi-dovish minutes we had from the FOMC, they are still adamant that we are going to get some sort of crash at some point. Let's have a quick look at the market anyway, see what's going on at the moment, see if they do actually have a point. Sorry, excuse me. Sorry, my throat gets really dry. I think it's the aircon. Anyway, like I say, one sign, remember, which we do see, is when we see dollar strength tweeted. I don't know, is it tweeted or is it sent out on Twitter? I'm too old for the youngsters' terminology. I don't know. Anyway, the euro is currently slightly under pressure. We've seen dollar strength really on the back since yesterday. Because like I say, the minutes yesterday was taken, like I said this morning, minutes were taken as semi-dovish, semi-hawkish. So the market is still thinking, okay, the pace of interest rates are going to slow down, but they're still going to do it. They're not going to stop. So anyways, still slightly under pressure, 1.0125 at the moment. So yeah, we are still seeing dollar strength against the single currency as well. And if you look on a daily, again, not much movement. It's still finding a little bit of buying just above that key level, 1.00716. Buying first level is testing around 1.1020 at the moment as well. So yeah, bear that in mind. Yes, September announcement would be interesting before Q4 if a recession hits. Like I say, I'll talk about that in a minute, but that's a good question. It will be extremely interesting to see what they announce, if they will do 75 or 50. I think the market's swaying to 50, but I have a chat, but that's a good question. That is a good question. So yeah, let's have a look at the sterling again. It is hovering around. It's actually hovering around that key level I keep talking about, 1.20034. And as you can see, it's maintaining that for now. But we've got dollar strength against the sterling. But again, like I said before, though it's holding for now, we'll have to see if it can hold on for much longer. But like I say, the sterling has got its own issues, a lot more issues coming up, especially like with inflation at 10.1 as a prime example. And let's have a look as well. Gold. Okay, dollar strength again, carrying on the momentum which started on Friday, last Friday, and carried on the momentum, started the momentum from pretty much from the FOMC minutes yesterday as well. Still, still dollar strength, $1,765 currently trading at the moment. And like I say, yes, it's tempted to break the level of 1,791. It's failed to do so for the time being. I want to have a quick look at equities now, see how they're getting on. Okay, because on the day they are negative. So this will be, they close negative. It'll be 2 days on the run, which they will be negative. If you look at a short term, okay, short term is S&P 500. You can see, okay, it's been a bit sideways. Okay, though there's a little bit of buying in it at the moment. It's trading at 4,268 points 59 cents. This is what I want to show you. This is what I want to look at in particular. We go back to a daily, okay? Go back to the daily. On this bull run we've had, or I think it's a bear market rally. On this bull run, the S&P 500 managed to reach, this is on a daily, remember, the 200 moving average. Okay, 200 moving average. Since it touched it, gave it like a little kiss, it started to be sold off as well. So does Jim Cramer and Michael Burry, do they have a point that we are about to see a cooling off period after this run? Because as we can see from the beginning of June, when they hit their lows, we've had a bit of a bull rally, which I think, I think, to be totally open with you, I think is a bear market rally. Mr. Peter, okay, unfortunately, I don't know, because I'm just do the analysis. It's best to talk to, obviously, your manager to see if there's a technical issue from your side. But they're definitely, or customer support, they'll definitely be able to support you on that. So please reach out to them. They should be able to help you ASAP. Right, what else was I going to say? Okay, yeah, so like I say, does Jim Cramer and does Michael Burry, do they have a point? Do they have a point? So yeah, that's interesting to see. The NASDAQ as well. Let's have a look at the tech as well. Again, like I say, this is on a daily. Okay, it didn't get quite close to the 200 simple moving average like the S&P did, which is interesting. But it's still underneath it. Don't forget, if it's underneath the 200 moving average, it is still indicating, in many ways, potentially of a downtrend maintaining. So it is interesting to watch. Let's have a quick look at Bitcoin, see how that is failing or how that is doing at the moment as well, because obviously that's a risk-on asset. If we got risk buying, then clearly something like Bitcoin is going to benefit. Still trading at $23,453. So pretty sideways at the moment. It did experience, this is on a daily again, remember. Thank you, Peter. Thank you. And thank you for coming, Peter. It's a pleasure. It's a pleasure. Obviously is. Thank you, buddy. It's a real pleasure. Thank you. And like I say, it's trading on the 3 days. Or the last 3 days, it's closed lower. So it's finding a little bit of buying at the moment. But again, it's pretty sideways as it is. So this brings me back to one I wanted to talk about, additional to us going over this. And that is really, is the labor market, the US labor market, is it acting as a shield? Is it helping us deny the fact that so many other sectors is under strain? And it is only a matter of time till literally we do slip into a recession. Don't forget the UK had reasonable job data as well the other day. The claimant count was a little lower than it was anticipated, but the UK labour market was still pretty good. Their unemployment level still came in at 3.8%, so still as expected. So even the UK labour market is pretty robust, but the US is robust, and it keeps being impressive because, like I say, the labour market is the last thing. It's the last thing to break when the bell breaks. It's the last thing to break off. Is the labour market. So I just wonder whether this is putting us in denial that we're going to get a hard or medium landing, not a soft landing, which the Fed keeps pretending to be. But tell me, what do you think? What do you think about this? I mean, there is a reason why we do have a strong labour market, and one of the factors are, and this is in the UK and the US and across sort of Europe as well. One of the reasons why we have a strong labour market is the working environment has changed. It has changed since COVID. Okay, after COVID, a number of individuals retired because they obviously got used to working at home, and they retired, which is freeing up a number of positions as well. So that's a major factor why we got a good labour market at the moment. But when growth stops, that labour market will not be as tight or as strong. So bear that in mind. So I'm just again opening it up to the room. Do you think that this labour market is giving us a false security blanket over to the fact that something is coming? Or are we being over bearish? Are we over bearish? Is the bad negative stuff already priced in, which some people say? And I tell you what, I think this is all going to come to, which is, I think it's the first one. Going on to the question SMF 790 mentioned. There's something bigger than that beforehand, something else coming up next week, and that's the Jackson Hole Symposium, okay, where the Fed will meet, okay, and the Fed will speak, etc., about their comments. And many people are thinking this could be at a time when the Fed literally pokes the bear and wakes the bear up for the market. So I'll talk a lot more about that next week. It starts on the 26th. So that's a big event coming up. So I'll talk a lot more about that because that could potentially really stir the market. So do bear that in mind. Markets as they currently stand, FTSE is currently trading at negative 0.07%. DAX currently trading at 0.31%. Eurostoxx 50 currently trading at negative 0.13%. Okay, so that's how it stands at the moment. Don't forget, you can carry on asking me questions anytime you wish in reference to the market and anything else, and share me your opinion. Tell me your opinion, what you think, and what's happening in the market. So let me, feel free, or just simply to say hi if you like. Am I over bearish? Do you think I'm wrong? Because I have been a bit of a bear for quite a while, I must admit. I've been a bit of a bear, but yeah. So feel free to ask me or share me your opinions. I always value it, because everybody at the end of the day has their opinion and their ideas on the market. Or let me know what do you guys trade? What are you trading at the moment? That sort of thing. Anything like that. Don't forget, we have got a new series coming up as well. Hashtag Ask James, which we're launching really soon. Like I say, there is and there isn't. There's a lot of summer jobs, obviously. Don't forget, job numbers are taken up with people doing summer jobs like beaches, things like that, etc. And then obviously, certain individual parents can start going back to work full time as well. But nowadays, so many work from home anyway. So the fact that going back to school doesn't really affect. But that's a good question. There's not necessarily any trends necessarily after the summer. You might see a small drop in certain vacancies, though, like the summer jobs, because obviously they're not so popular anymore or not so readily available. But it's not going to be dramatic because of the summer. It's not that dramatic. But good question. Very good question. Yeah, but as I was saying, don't forget, we are launching a brand new series as well called Hashtag Ask James. I was hoping to go live for the first one tomorrow, but we're not quite ready, unfortunately. So it's going to be next week instead. This series, okay, is very different from the normal tixee Live broadcasts and the watch-alongs. This is purely based on educational purposes only. So basically what we'll do a whole live video on a topic of your choice. You choose a topic or what you want to cover. I want me to cover, and we'll do an educational live broadcast covering and talking about this topic. So whatever you want to learn. Now, I've got 2 topics already. SMF 790 has already requested a special video on me to discuss market jargon, which obviously is for new beginners, because I know I talk a lot of market jargon. I try to explain it, but sometimes I forget because I get too overexcited. And then we've got another one. So we've got 2 in the pipeline already. And then another one is explaining candlesticks. Okay, and that was a suggestion done by Jay Davis, which again is a fantastic suggestion. And I'm definitely going to do those 2 episodes. So any suggestions, anything you want to learn, you want me to talk about, make it, put it on the chat while I'm talking, or while we're live, or put it in the comment section on Facebook or YouTube, whatever, wherever you wish. But anyway, okay, don't forget, if you think of a question later, you can put it in the comments on either Facebook and YouTube. I will see them and I will reply to them next time I go live. So anyway, if there's no questions, not a problem. Don't forget, if you're watching me on Facebook, by all means, give us a follow. If you're watching me on YouTube and you've enjoyed this video, give us a subscribe if you like. Hit the notification button so you know next time we're going live. Don't forget, I'm back on again tomorrow at 8 a.m. UTC, and of course again at 2 p.m. UTC. So, don't forget, we got that, and it's the end of the week as well. So I'll do my famous Friday wrap up of all the events we've had this week as well. So it should be a good little episode. On that note, I really appreciate it as well. If you enjoyed this little video and you put up with me, my over the top enthusiasm about the markets, give me one of these. It's nice to know that you like what I do. Anyway, for now, big shout out to SMF 790 and Mr. Peter for interacting and saying hello. I really appreciate that. Really appreciate all that interaction. Plus, a big thank out to all of you who've kindly come along to watch me today. I hope you enjoyed it. But anyway, remember, till next time, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.